Janet Yellen, a Teflon stock market, and, well, America's path to a soft economic landing? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
You said that with a question mark.
It was kind of a question mark.
You don't believe it. It was dot question mark.
I don't know. Am I allowed to say that?
Yes, because David Solomon agrees with you. He doesn't necessarily believe it either. I'm Alex Steele. We're kicking you off to the closing bell right here in the U.S. All right, a check here on where markets stand. The S&P going nowhere, and I mean absolutely nowhere fast, up by about 0.1%. But some interesting fun stories to look at. First is Apple. That stock up by 0.3%. You're looking at the NASDAQ 100 also up a little bit. Apple is abandoning its EV car plans. The market seems to like that. We also had a 7-year auction today, but not just that. A lot of supply yesterday, supply over in France as well. The takedown really solid, the 10-year yield just up by 3 basis points. And here's a head scratcher for you. Dollar yen down just 0.1%. The 2-year yield over in Japan hit the highest level since 2011 after inflation backing out fresh food hit surprise to the upside. Yet dollar yen again not really moving. And I wonder, Roman, is it a U.S. exceptionalism kind of thing?
Yeah, I don't know. You're killing me with dollar yen today, Alex. 150.53. I feel like we've been there for a while. And if that's not killing you, how about talks of a soft landing? We're back to that conversation again, but that's actually what's been underpinning the bid that we've been seeing today in U.S. equity markets, particularly into industrial materials and other economically sensitive cyclical stocks. You had a draft of the G20's closing statement come out. This is going to be the statement that comes out at the end of this week's meeting in Brazil, and it's going to say that the risks to the global outlook are more balanced and the world economy actually has a growing chance of pulling off a soft landing. U.S. Treasury Secretary Janet Yellen putting a finer point on that at a news conference in Sao Paulo.
Had a U.S. recession come in 2023, like many predicted, global growth would have been thrown off track. While there are risks to our outlook, America's growth has consistently exceeded projections. In short, America's path to a soft landing has underpinned global growth.
And look, I'd be remiss in trying to doubt the outlook from one of the world's most renowned economists out there, but it doesn't quite sync up with some of the latest batch of economic data. U.S. consumer confidence falling in February for the first time in 4 months. This says views about the job market and financial conditions did deteriorate. Meanwhile, you had orders placed with U.S. factories for business equipment that barely rose in January after falling the prior month, really suggesting that companies out there are restraining their investment amid what is still, yes, an uncertain outlook. And that brings us back to the Teflon stock market, the resilient bond market, and Alex, almost $3 trillion in cash that had fled into money markets, I should say, since the start of the pandemic.
Yeah, and then you take a look at, say, Janet Yellen versus the data that we got. We take a look at then the data versus the S&P, right? And then higher yields, too. So here's something I found really interesting, and it kind of speaks to this Teflon market and something that makes me scratch my head a little bit. So I just want to focus in on right here. So this line here, the white line is the S&P, and then the orange line are 2-year yields. This is on a normalized basis, by the way. So when you wind up having 2-year yields hit that high that we saw back in 2023, you saw the low around October for 2023 for the S&P. Now, what's interesting here is that both are moving higher together. You see the 2-year yield now near its peak that we saw back in 2023, yet the S&P continues to grind higher. So it begs the question, does that make sense? If we do have a soft landing, that might make sense. If we don't, one of them is going to be mispriced, Romaine. The question is which one and which view is right.
All right, well, I can't answer that question, but maybe our first guest can. Jerome Schneider is kicking us off to the close here on this Tuesday afternoon, Managing Director and Head of Short-Term Portfolio Management and Funding over at Pimco. And Jerome, I don't know if you heard Alex's question, but I'll just steal her question here, and I'd like to get your thoughts on that.
Yeah, absolutely. I think that there is obviously a natural tendency to see where the peak in rates makes perhaps risk-taking a little bit less sustainable as we witnessed in 2023. But I think one of the main factors here is as we continue on, there is a notion that the soft landing is potentially possible. At Pimco, we think that there's some of the macroeconomic data which perhaps portends to a little bit more deterioration. Perhaps some of the ISMs later this week will point to that. But ultimately, what we think is that the economy still moves forward at a slower GDP growth than we saw back in 2023, which doesn't necessarily forebode a deep recession or the like. We just have to get more comfortable that as we have higher rates, ones that are more in tune with the Fed's outlook, we're going to necessarily see that risk-taking be a little bit more subdued over longer periods of time. And more importantly, that risk-taking is going to be more specific in certain elements of risk-taking in specific sectors versus a broad-based risk-taking that's happened. So we do think that there ultimately is going to be a recalibration, if you will, of tendencies of how you think about fixed income versus equities. But specifically where we are right now, we're finding that fixed income element much more attractive in terms of volatility management, in terms of income potential, and total return at that point in time.
And we've seen, at least for maybe the last 3.5 months or so, Jerome, some bit of extension of duration, the idea that you don't necessarily have to stay camped out in T-bills or money market funds, that there is life across the spectrum.
Right. You know, what we're ultimately are seeing over the past 4 weeks or so is that this rate adjustment, the movement toward these higher yields that we haven't seen in quite a while, is creating a sense of opportunity. Perhaps some of those investors who missed some of the higher yields back in 2023 are revisiting that, and more importantly, looking to move some of those assets out of cash. Even though cash rates are still near that peak that we've witnessed for a long period of time, they want to take advantage of some of that price appreciation, which will end up ultimately developing once the Federal Reserve moves into action later on this year. And I think that calibration between the Federal Reserve's continual focus on managing price stability, managing job growth, and doing so in an economy, in a marketplace where they want to focus on financial conditions and financial stability, ultimately leads that market reconciliation to come closer to those Fed expectations. And that's exactly what we've witnessed. So investors want to begin to think about what that means to their portfolio and not necessarily miss the opportunity to extend that duration out of the cash component of their portfolios, which has been inundated over the past few years.
Yeah, I was wondering, I have a CD maturing. I know, CDs, I'm so old school. And I was like, what do I do now? Do I go back to CDs?
Yeah, there's so many opportunities.
I know, there's different options now than, 18 months ago when I first put it in there. Jerome, are you of the camp like Janet Yellen that, okay, we're looking at a soft landing, or are you of the David Solomon and Romaine Bostick camp where you're a little bit more skeptical?
Yeah, you probably have to thread the needle a bit. Here at Pimco, we're sort of thinking about the historical precedent in a way, thinking that the components, the variables necessitated for a soft landing, it takes a lot to really make sure that equation comes out precise. But yet at the same time, we're sort of seeing some of those macroeconomic indicators slow a bit. So while there's a potential for a soft landing, it's not a highly probable event in our book. So what we're thinking about is a risk scenario that begins to materialize over the course of 2024 into 2025, where perhaps some things like wage pressures, job growth in general becomes a little bit more subdued as profitability in the corporate sector, not just in the U.S., but globally begins to weigh on sentiments at that point in time. Again, not in a hard landing at all, but the soft landing is a bit idealistic when you take it from a historical context that we've been evaluating at Pimco.
See, Romaine, that works. That's what you're saying, perspective. Yeah. Jerome, where should that money then that's in my money market fund belong to? Should it belong to the corporate credit market? Where along the curve does it belong to? I mean, I've been really stunned at the amount of issuance that we've seen, also just the amount of demand that we've seen, even over with OATs in France. What do you think?
Yeah, there's a demand component which is self-fulfilling. Let me spend a moment on that. That we continue to see trends in money market funds continue to move higher over the course of the first quarter of this year. And what we're ultimately seeing is that there's a bit of self-propelled inertia within that. Money market funds spin off about $25 billion of income on a monthly basis to their investors, which means ultimately they're going to have to be reinvested in some way, shape, or form. Sure, we're seeing some of that go into risk assets. We're seeing it extend out the yield curve in terms of duration, but a lot of it actually gets recycled within money market funds itself, creating an upward trajectory to assets under management. I think the key point here is that when you want to think about the balance of how to put that capital to work, a lot of investors are shying away from embracing volatility, finding risk assets, and looking more for that income-based component, which really is ultimately a volatility management story at this point in time in 2024. While we find it relatively attractive, and you highlighted earlier on Bloomberg this morning that we only have about 75 basis points of rate cuts priced into the 2024 market pricing at this point in time for the Fed, the reality is that's really pretty close to where we see as fair value. And investors should use this as an opportunity to move out the yield curve, to embrace some potential for capital appreciation, for price appreciation from bonds, but also earn and lock in, frankly, healthier incomes for longer that money market funds simply can't sustain once the Fed begins to cut rates. And that's sort of the logical precedent here. Investors in cash strategies, perhaps your CD, Alex, want to necessitate earning that income at higher yields for longer at this point in time. And that it requires a little bit of maturity extension or extension of interest rate exposure to manage that over those points in time. So investors ultimately want to position for themselves of price appreciation in bonds by extending out the yield curve.
All right, Jerome, great stuff as always. Jerome Schneider, the head of short-term portfolio management and funding at Pimco, helping us kick you off to the close here on this Tuesday afternoon. Coming up after the break, a closer look at Macy's. Plans to close about a third of its U.S. locations. Highlights from my conversation with the new CEO, Tony Spring.
Plus, you got Tom Palmer, president and CEO of Newmont, will be joining the program live from the BMO Global Metals and Mining Conference.
And forget Ozempic, forget Zepbound, VK2735. That's the newest weight loss drug on the block, and Viking Therapeutics, the hottest stock on the street today. We're going to talk about the latest trial of the new weight loss drug. It's our stock of the hour. All that and more coming up in a bit. This is The Close on Bloomberg.
Here's the story of the day. If you work at a bank, keep an eye out for AI. That was a hard sentence. A new study finds out from Accenture that artificial intelligence is likely to impact tasks making up about 3/4 of each day. Bloomberg finance reporter Catherine Doherty has more. That's a lot, 3/4. What tasks are we talking about?
So the ones that will be the most automated are the ones that deal the most with numbers, with data that can be easily consumed by these generated systems. Think about a bank teller, for example, that's trying to evaluate, maybe there's a consumer that comes in and is asking about their account, how much money they have. A lot of these answers can be automated. You can use bots to potentially answer a question faster, or you may not even need a person at all. So a bank teller might shift to only answer the questions that need a personal touch, need someone that can analyze something that maybe a computer can't process themselves.
So when I saw this, my first thought was they still have bank tellers, but I guess I guess they still exist out there. But I feel like there's already been enough attrition in certain pockets of the banking sector where maybe this won't have a material impact on jobs, or is that just hopeful thinking?
So you're right. I mean, there has been a transition even before AI. And also, to make this clear, AI has been a technology that has been around for a decade plus. But we're talking generative AI, so large language model. These are both using data, but then giving an answer that could be given as a sentence, using actual English as a language. If you're going in, let's say if you're walking outside of New York, a bank teller might not be necessary. And so but there's other, think about a loan officer. That's another impacted job that might be able to take and evaluate someone's credit worthiness, whether a bank could, what kind of options might be available to a consumer. Those are some tasks that can be automated as well.
And Alex is trying to roll over one of her CDs. I think it's like her and the grandmas.
Literally. I had a CD back in like 2002 and then now. I don't know what that says about me. But what I'm interested in is where those workers go. Are there other job opportunities for them, or in net, let's be real, in about 5 years, they won't exist at that firm or that bank anymore?
So the roles that will be the most automated, those teams will likely shrink. This report was saying, though, that there are alternatives. So instead of just massive cuts across banking, you could see people moving into other areas, other teams that might need more of a personal touch, that aren't as automated. But across the board, the big headline number here is 3/4 of all of the time that is spent across the banking sector will be affected, whether that's automated or augmented. And so it's going to be touched in some way. It's just a matter of, will you be assisted? Will that time be replaced by a bot? And in that time, if it is replaced, can you use that in other ways to do other jobs to accelerate potentially helping a consumer or getting a deal done, for example.
All right, Catherine Doherty, a closer look here at the latest study out by Accenture, and a closer look at how AI could replace a lot of banking jobs. We want to stick with AI because there was some interesting news crossing the wire a little while ago, Alex, saying that Apple is finally acknowledging that that effort to build an electric car might have been an effort in vain, abandoning that project and actually moving a lot of those employees over to their AI division.
Yeah, I find this interesting for two reasons. One, because they got in late anyway.
Yeah.
And they usually get in late to a product. They want to see how it goes elsewhere. So it's interesting, the timing of it. My other is that in some ways it makes sense. Like AI could generate part of a streaming revenue for them and become a services company, which is what they're trying to do. I'm not quite sure how a car would have done that for them.
Well, one thing that was intriguing about the car when it first we first learned about it was it really was supposed to be fully autonomous, and then they kind of backed off and said, well, the technology is not quite there, and I don't know, maybe they just reached a point where they just said, look, this just is way ahead of its time right now, at least from a profitability perspective. And I know there was a lot of discussions about how much an Apple car would even cost, and most people say that was going to be in the six figures, which last time I checked, most people aren't in the market for a six-figure car.
No thanks.
Yeah.
And that wasn't enough margin for them, apparently, so.
Yeah.
Ouch.
Well, there's always, the iPhone.
There's what, that CD. That's why I'm in the CD. It's going to help me pay for that Apple car.
All right, stick with us. We'll be back in a moment. This is The Close on Bloomberg. Let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start with Unity Software. Can't catch a break. Price target being cut to 30 from 35. This over at Jefferies with analyst Brent Thill citing disappointment with the video game developers' annual sales forecasts. The lack of clear strategic direction. Those are the words he used, saying that's why he maintains a hold rating on the stock. Investors bailing down 7% on the day. Roku up next, getting cut to underweight from equal weight over at Wells Fargo. The price target going all the way down to $51 a share, with the analyst citing substantial risk on the back of Walmart's plans to buy smart TV maker Vizio, saying Roku will need to reposition itself in such a competitive landscape. The share is only down fractionally, but they're down about 36% just in the last 2 weeks since we first learned about that Walmart deal. And finally, let's take a look at American Eagle Outfitters. Citi opening a 90-day catalyst watch on the stock with expectations for the apparel retailer to issue a strong annual profit outlook when it reports next week. The analyst seeing solid momentum at both the Aerie and American Eagle brands and praises the company's commitment to managing its costs. Those shares are moving higher on by about 1% here on the day, and those are some of our top calls. We do want to stay in the retail space and take a look at a bold new chapter. At least that's how Macy's is spinning it. That's the new strategy from the new CEO, an effort to free up assets that the retailer announced would involve closing about 150 of its namesake stores. Now, earlier I did have a chance to catch up with the new CEO, Tony Spring, about this new chapter, and here's what he had to say. He said it's not the quantity of stores, it's the quality. It's the right stores in the right geographic parts of the country where consumers are still shopping. David Schwartz joining us right now for his perspective. He's Morningstar's senior equity analyst, and he has a buy rating on Macy's shares. And I do want to start there. Hey, just give me a sense here. When you saw this roadmap, this bold new chapter outline, which is primarily closing stores, getting inventory under control, and maintaining some of the other cost controls that were kind of already in place under his predecessor, were you impressed by what you heard today?
I think it's a needed step. It's probably long overdue. Many people, including myself, have said and written that Macy's still has way too many stores in B and C class malls that really need to close. Macy's has been hesitant to close them in the past, although they have closed a lot of stores. I think that Macy's really wanted to keep stores open that it saw as profitable on a four-wall basis, but ultimately they were not really driving much profitability at the company. So there needed to be some big changes, and bringing in a new CEO is a good chance to bring in some new changes to the company.
Certainly a big chance here. We'd be remiss in not pointing out that, of course, we're talking about activist investors circling this company. You have companies like Ark House, which have made it clear that they see value that could be unlocked by selling off more of these real estate assets much more aggressively here. Do you think the 150 stores that we got today is going to maybe placate some of those investors?
No, I don't think so, because most likely the 150 stores that are going to be closed are not the prime real estate stores, because the prime real estate stores are the ones that are the best performing stores for Macy's. So those are the ones that won't be closed. So I don't think this is going to pacify the activist investors at all. I think that they're going to go ahead with their takeover attempt. I don't necessarily think it'll be successful, but I think that it's going to continue because Arkhouse and others in the past have seen that Macy's owns significant real estate, and it doesn't really have a plan to monetize that real estate. Closing some weaker stores is not really the kind of big plan that Macy's investors have been looking for years to actually unlock the value of that real estate.
So what would be that plan? Like, what would that gigantic real estate monetization look like?
Well, there's a couple things that Macy's could do. It could create a REIT, would be one possibility. Other retailers and casinos, for example, have done that. Another possibility would, which is probably easier, would be a sale leaseback, which would be to sell all the real estate to a real estate investment firm and then lease it back. That does put the company at risk because the company would then have to pay significant rent on the buildings. And right now, Macy's pays very limited rent on most of its properties. So there is risk to that. And I think that's why Macy's board is really hesitant to sell to a company like the one that's trying to buy it now, because they don't see that as a company that's really going to take care of Macy's for the future.
So what are some other levers then to pull? Like, if they're not going to take that dramatic of a step, they also streamlined their inventories, they automated a lot, they managed their logistics, they really trimmed a lot of management fat. What else is there to do?
Well, Macy's main move right now is to try to open smaller stores. So Macy's is going to be closing a lot of those bigger department stores. They're about 180,000 square feet on average. The market right now does not need those giant department stores. So Macy's is going to be closing a lot of them and then opening smaller stores, probably 30, 40,000 square feet, mostly in retail that is off mall. So mostly in strip malls, places like you'll see stores from Ross and Rack and DSW, stores like that. So Macy's is really moving towards an off mall model. It's been a slow move because Macy's had hundreds of stores in malls, but that's really where Macy's is going. It's not really a real estate strategy, though, and so the people that want to own Macy's for the real estate are still going to be unhappy that Macy's doesn't really have a big plan to monetize the real estate.
Got it. All right, David, thanks a lot. David Schwartz over at Morningstar. Romain, what were some other big takeaways?
Well, I'm glad that last point he made, that this isn't really a real estate strategy. And he's spot on, because that was my sense in talking to Tony. He talks so much about how to improve the retail experience, which is what you want to hear from a CEO. But of course, most of these activist investors are really looking at the crown jewels of this company, which as of today still remains what some people estimate to be about $8 billion worth of real estate.
Which then begs the question, like, how do you increase your operating margin? Like, how do you do those things if you don't really try and monetize real estate?
Well, yeah, I mean, but he did talk a lot about improving the experience, making it more experiential to come in the stores, more visual merchandising. And then what he talked about, too, the idea of reducing a lot of redundancy. He said they have way too many brands, way too much overlap, and if they can get rid of some of that, that might improve margins.
No, fair enough. Yeah. All right, coming up, we'll stay with the C-suite here. We're going to go to Newmont Mining, Tom Palmer. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Boston.
And I'm Alex Steele. Guess what? One of my favorite stories of the day.
What's that?
Hess, Chevron, Exxon, and CNOOC. So Hess is one of the worst performing stocks within the S&P. Chevron's also up by a couple percent. This is basically a fight about Guyana. So Chevron made a really big bid for Hess. That merger is supposed to go through here. And the main crown jewel is Guyana. Yeah. And Exxon and CNOOC are partners with Hess. And Exxon and CNOOC now have said that they have the right of first refusal. Well, I should say that Chevron had that in a filing. Yeah. They have said they have right of first refusal of Guyana.
So I am curious. I saw this and I was a little confused. What does Exxon get out of blocking this deal?
In theory, they're making the point that they should be entitled to Hess's portion of Guyana. So Chevron can buy Hess, sure, but they can't get the Guyana piece.
Oh, so even if they bought Hess.
Right. Which, of course, like the idea is that Hess isn't worth anything to Chevron without Guyana.
I am curious. I mean, I feel like everything going on in Guyana right now is just a bit of a mess. Between what we're now learning about Exxon versus Chevron versus Hess or whoever else I'm forgetting, and then, of course, whatever the heck is going on with Venezuela, basically claiming that some of this oil or these oil reserves are actually on their property effectively instead of Guyana. Is this going to end in what, some big fight?
I mean, that's the interesting part is that we're all worried. We're all thinking about like DOJ or antitrust, right?
Yeah.
We're all thinking about what's going to happen with Venezuela. Are they going to actually try and co-opt some of these assets off the coast, right? No one was thinking that this was going to go down. That one of the material risks to this closing, according to Chevron, was going to be CNOOC and Exxon.
And remind us and remind the viewers, I mean, because you cover this pretty closely. I mean, the oil discovery off the coast there, that is one of the more meaningful discoveries we've had in a while.
In decades,
Yeah.
I cannot really emphasize it enough. Like the Permian Basin and shale oil in the U.S. was one thing, but this is not that. I mean, this is deep water, and these big guys are not exploring to the same extent that they did 30, 40 years ago. So this is the asset, unless you're looking at a Qatar and natural gas fields, or Saudi Arabia. Like this is where the real production exploration is going to be, and the asset there could be enormous. It's super valuable.
So final question for you, Alex Steele. I thought whenever you sort of make these types of deals, usually you sit down with a bunch of lawyers and other sort of consultants, and they kind of talk about all the potential risk. Was this not discussed?
Well, that's what we were talking about earlier.
Yeah.
Like, weren't the lawyers like, dude, you're good, don't worry about it? And you have Chevron calling up their lawyers being like, no, seriously, tell me this is okay?
Yeah.
I don't know. Gotta be honest with you. You would think this would have been gone over here. All right, well, one stock we're also watching, we stay in the commodity space, is Newmont Mining. So those shares are down by about 0.5%. Argus Research cutting its rating to hold from buy, saying the gold prices are trading near the top end of their 5-year range and might not substantially move higher. Joining us now from the BMO Global Metals and Mining Conference is Tom Palmer, President and CEO of Newmont. Hey, Tom, it's great to see you again. Thanks so much for joining.
Thanks for having me, Alex.
So basically, gold price isn't going to go much further from here, so therefore neither can your stock. What do you say to that from Argus?
Our stock is at a once-in-a-generational price. Last week was a big week for Newmont. We announced, following our big acquisition of Newcrest, a go-forward portfolio that's never been seen before in the gold industry. It's all tier one operations. It's got great exposure to copper. It's got some great projects sitting in behind it. If you come into Newmont stock now and ride the value with us, back us, you are going to go for a journey with us that will significantly increase that stock from where it is today.
Tom, I'm laughing because that was a CEO answer if I've ever heard one. On the flip side, though, you're looking at cutting the quarterly dividend when you reported, and you had to reset your dividend policy in part because you're absorbing Newcrest, and you have to sell a lot of assets to kind of make this acquisition happen, and you have to deal with synergies and stuff. Part of that is $2 billion in cash sale of assets. How's that going?
All going to plan, Alex. It's what we announced back in May of last year when we announced the deal. We said there'd be synergies. We said there'd be $2 billion of cash from portfolio optimization. We expected to adjust our capital allocation to match the transformed business. We'll get our balance sheet nice and fit. We'll pay a $1 a share base dividend. We'll get $2 billion of proceeds at least coming in from those divestments. And a good portion of that money will go towards our $1 billion share buyback. Everything consistent with what we announced in May of last year.
How soon do you think those divestments will come, Tom? And once they are done, where does that put Newmont next?
We committed to work through 6 assets that we held for divestment. We worked through those for the course of the next 12 months. Process has started with 2 of them. There's a bunch in North America that will start in the next month or so. So we're on track, got clear plans to have that work through over the course of this year. Our focus is on delivering the value and the synergies from our go-forward Tier 1 portfolio. That's our focus for 2024. Get beyond that. We've got some very big copper-gold projects sitting in the wings waiting to increase our exposure to copper in 25, 26 and beyond. Really exciting time.
Are those new projects, are they of the same cost effectiveness as what you have now?
We have projects that are the envy of not only the gold mining industry, the mining industry. We have 3 big copper-gold projects, one in British Columbia, one in Peru, one in Papua New Guinea. They are of a scale that is the match of any copper mining, gold mining company. A really exciting project pipeline that we have sitting there waiting to be implemented.
Mark Bristow might challenge you on that, Tom, but fair enough. Tom, I'm curious as to how running your business in terms of your input cost, your labor, your energy costs, what are you noticing? What's the trend? What's this year going to be for you on that front?
Everything's pretty consistent with what we're predicting for this year and probably pretty consistent with what we saw last year. So there is some stability in terms of our cost base. what also comes as we transform our business. We'll be about $1,300 an ounce this year is what we've guided to. But as we bring on new ounces and improve costs with our transformed portfolio over the next 2 or 3 years, we'll bring that down to $1,150 an ounce. So really strong margins out of our portfolio. So it's a combination of focus on cost, productivity improvements, but also new ounces that we're investing in to bring on board over the next 2 or 3 years.
Tom, as inflation sort of rolls over, as the Fed winds up cutting rates, Abu has Bitcoin ETFs, maybe Ether ETFs coming onto the market. Do you feel like that's just going to, at some point, stop gold's rise? There are just other assets and other macro factors that's going to make gold as an asset class less appealing, which then filters down to Newmont stock?
We're pretty excited about the long-term view of gold. We wouldn't have the size of Tier 1 portfolio that we have. We've got 10 Tier 1 operations in our portfolio. We're very excited about the potential of gold, the long-term potential of gold. But the key is to have a margin to whatever that gold price is. So when you're running at $1,100, $1,200 an ounce, you've got a great margin, you're resilient, means you can be generating cash through the cycle, and that's our focus with our long-term portfolio.
Hey, Tom, great to see you. Thanks a lot for joining us. We really appreciate it. Tom Palmer, Newmont President and Chief Executive Officer, joining us from the BMO Capital Metal and Mining Conference. It is interesting, though. I was covering gold back, 17 years ago or something during the financial crisis. And if you told me that gold was at $2,000 an ounce, these stocks would have been flying higher. It's interesting how that correlation has changed over the last decade plus.
And I am curious, though, to see sort of how the future of mining shakes out when we've heard so much about some of the, I guess, less cost effectiveness of it now, particularly with certain metals, not necessarily gold, but some of the other ones, including copper that he mentioned there. So I'll be interested to see how he deals with that.
Yep, and then, go ahead.
On a completely unrelated
note,
I was reading this story about this guy who was supposed to fly to Hollywood, California, and he got on a flight to Hollywood, Florida.
What?
I don't know why. I just kept thinking about that the whole interview. I could not stop.
How does that happen? Don't they check like your tickets and stuff?
I don't know.
Is this Home Alone 2?
I don't know. I think it's like Home Alone 5.0 or something. So.
I don't know where to go from there because that's just weird.
Yeah.
And you think when they're like, here's your flight to Hollywood, California, they would have thought about it.
Yeah, something to think about tonight.
Cool. I'm glad we got that there. All right, coming up. It's the newcomer among the weight loss drugs. You got shares
no dinner for us. Weight loss.
No dinner. Viking Therapeutics is surging. Oh my gosh, 123%. Can that be right? After mid-stage trial results for its obesity drug exceeded expectations. We're going to break that down for you in today's Stock of the Hour coming up. This is Bloomberg.
All right, time now for our Stock of the Hour, and it's a hot one. Viking Therapeutics, more than doubling today alone. This is after positive trial results of the company's obesity drug. Bloomberg's Madison Muller joining us right now, who covers the weight loss drug industry, and it has become an industry. We talk about Wegovy, Ozempic, Zepbound. Now this new one, VK2735, the shares are rallying on this. So what? Is this better than Zepbound? Can I go out and start taking this tomorrow?
Well, the thing is, it's still years away, potentially, from reaching patients.
Okay.
And that's why it's kind of amazing that the market reacted like it did to this data readout today, because it's still in mid-stage trials. You know, patients aren't going to be able to go to the pharmacy and get it anytime soon. It still has to succeed and show positive results in a phase 3 trial before even getting approved.
Well, with the trial that they had, what did it show? What was so positive about it?
Yeah, so it showed, 14.7% weight loss in 13 weeks, which is a really good result, and it looks to be tolerable. Patients didn't have, really bad side effects, so it looks to be safe. And that level of weight loss puts it on par to compete with Ozempic, Wegovy, Zepbound. And so that's what I think the market was reacting to a little bit today, too, is it looks to be the best in obviously still early stage, like we said, but looks to be the best in the rivals.
I was just going over that 14.7, trying to decide how many pounds that would be.
How did you, did you figure it out, or?
Yeah, it's like 3 pounds.
Oh, okay, so that doesn't really move the needle as much, okay. But you know what the idea is that this reminds me, but this comes with data, that like, what was it, 6 or 8 months ago, any company that said AI in their conference call, you saw their stock spike up after hours or pre-market because of it. this feels similar, but this comes with real stuff. It's not
Yeah.
just like a hope. It's like they
Yeah.
have data to prove it. So that makes me think that it is real, and this is a longer runway.
Yeah, and we've seen that a little bit too with pharma companies. Like if they mention weight loss drugs in their earnings calls, or they say that they're developing a weight loss drug, it's seen as a positive and seen as upside. And so this is obviously data, like you said, but
I am curious, though, about the competition factor, right? Because there was so much enthusiasm over Novo and Lilly, primarily also because they were the kind of the only game in town.
Yeah.
But now you've got at least two other companies that seem like they're close to maybe having something on market. And there are at least, I don't know, by my count, at least 4 or 5 other companies that have something in development. And my guess is going to be more than that. Are we going to get to the point where it's just going to be so diluted and so many options that this isn't going to be a blockbuster for anybody?
I mean, that's a good question. I think one of the hopes is that having more drug makers in this space will hopefully make the drugs cheaper, because right now they're quite expensive, and that increased competition will hopefully be a positive thing for patients. And as more data is generated around all of the different health benefits from these drugs, hopefully that will encourage insurance companies also to cover these drugs. But I mean, the companies say that more entrance into this space is only a good thing, and it's only going to increase the market size. So I guess it sort of remains to be seen what happens for Lilly and Novo.
Well, they're definitely going to say, we love competition. Sure you do. All right, Madison, thanks a lot. Bloomberg's Madison Mueller joining us there. But I think the idea that like it's going to wind up solving all these other health problems 20, 30 years down the road, like that's the key for like Medicare, Medicaid, and insurance companies to cover it. That's what they have to prove.
Absolutely.
All right, well, coming up, you got a fresh slate of earnings results after the bell. eBay, Bumble, Cava, just a few of the names. We're going to break it down with Dennis DeBuscher, Chief Market Strategist over at 22V Research. That coming up next. This is The Close on Bloomberg.
All right, welcome back to The Close. As we count you down to the bells, a closer look here at one of the big stocks moving here in the cash session. UnitedHealth shares down 2.5%. This after the Wall Street Journal reported that the U.S. Justice Department has launched an antitrust probe of the health insurer. Based on the Wall Street Journal's reporting, we have learned that investigators have in recent weeks been interviewing healthcare industry representatives in sectors where UnitedHealth competes. That includes doctor groups, according to people with knowledge of the meetings. UnitedHealth shares had been relatively unchanged for most of the session, but that changed in a big way about 5 minutes ago, Alex, when that headline moved. The shares at one point down as much as 2.5%.
All right, the overall market, though, the S&P is just up by 0.1%. It is a snooze fest. The Nasdaq 100 is up by a touch. Taking a look at Apple, though, that's an interesting stock to watch when they ditch their EV car in favor, in some essence, of generative AI, market liking that up 0.7%. I do want to point out that the S&P Utilities Index is the best performing sector within the S&P. Constellation Energy doing really well, beating estimates. That's very much helping the stock as well. And let's end on small caps. S&P doing all right. You know what's outperforming? Small caps in a big, big way. Yeah, and you look at what types of small caps. It's really that cyclical trade, maybe a broadening out of this rally. The fact you see the lopsidedness here, that's what a lot of folks really wanted to see. Of course, investors are still eagerly awaiting the economic data that's going to come down the pike later this week. We had a chance to catch up with Pimco's Jerome Schneider on his view of the soft landing debate.
So what we're thinking about is a risk scenario that begins to materialize over the course of 2024 into 2025, where perhaps some things like wage pressures, job growth in general becomes a little bit more subdued as profitability in the corporate sector, not just in the U.S., but globally begins to weigh on sentiments at that point in time. Again, not a hard landing at all, but the soft landing is a bit idealistic when you take it from a historical context that we've been evaluating at Pimco.
And that was Jerome Schneider at Pimco, who helped kick us off to the close about an hour ago. Here to take us to the closing bells, Dennis DeBuscher, President and Chief Market Strategist at 22V Research. And Dennis, I do want to start there. There's been a lot of talk here about economic conditions and whether, I guess, the all clear, or maybe not the all clear, but at least enough clarity for investors to start rotating out of the safety of the Magnificent Seven and into something that's a little bit more economically sensitive, a little bit more cyclical.
Yeah, and you're seeing that today, as you mentioned. To get confidence on that, though, over the course of the cycle, you're going to need to see monetary policy volatility or expected monetary policy volatility continue to come down. That started the year coming down significantly. That's why you had that big broadening out of equities that worked in December, or I guess more 4Q in general, that reversed to start the year because economic growth has been so much stronger than expected. The Fed is hyper-focused on that, and there is some risk that if economic growth stays this strong of a level, then inflation won't come down to a place where they can, lower policy rate in a consistent way, and that would be a problem for an extension of the cycle and a broadening out of into more cyclical assets, into the average stock relative to the Mega 7.
Forgive me if this is a dumb question, Dennis, but for those folks who are looking to small caps, let's just take the Russell for example here, and trying to find whether there is a modicum of safety, is the correlation that they should look at, is that more tied to interest rates or more tied to the economic data itself?
At this point, it's more tied to interest rates. So one of the charts we've been highlighting, and we focus on this today, is the intense, deep negative correlation between relative performance of the Russell 2000 against 10-year yields. So 10-year yields moving up, Russell 2000 is going to significantly underperform. 10-year yields stable to lower, the Russell tends to do very well, assuming obviously 10-year yields are not moving lower because recession risk is increasing. So that is where you need to focus. And if we see a move from current levels on the 10-year year to 10-year yields, to 450 or well above that, then that would probably be a pretty big problem for Russell, assuming that's associated with more inflation risk.
So, Dennis, how do the options market, how do options traders or market participants using options to trade the Russell, say, versus the S&P?
That's a great question, because the volatility in the Russell is at just an absolute extreme against the S&P right now. So you're looking at the spread between Russell volatility and the S&P volatility, basically the highest it's ever been, so like 98th percentile. So you're seeing significantly more volatility priced within the Russell, which is where a lot of the hedging is going on relative to bad outcomes versus the S&P. So a way to think about this is a lot of potential negativity has been priced in the Russell, and to the extent that we see economic data that's kind of benign. What I mean by benign is data that doesn't suggest inflation is going to move up again, that it can steadily move down towards the Fed's target. You could see a collapse in volatility in the Russell relative to the S&P. And maybe you're starting to see a little bit of that today. We'll see what happens with the economic data over the next week. This will be really important. But this is a really important point, and thanks for bringing it up.
Yeah, you bet. I like options. I mean, I understand about half of it, or less, but still. So Dennis, to that point, I feel like rent the rally for the S&P has been the thing. I mean, like, the call volume outmatching the put volume, there's so many calls going in. It feels like that's the way we're trading now. Play the upside, forget the downside, despite the fact that we're record highs on the S&P. What do you do with that?
I think the one thing you do at an S&P level is fade forward returns, right? I think you have to say that over the next 6 months, when we looked at this historically in the data, your forward return profile, given what the option market is, and broader investor sentiment is suggesting right now, is that you should have lower than normal forward returns to the tune of roughly 1-ish% over the next 3 to 6 months, which is not terrible, but that's typically how this stuff has played out in the past. Now, maybe we move into a bubble. Maybe the cash returns of these megas are so intense that, all history gets, market history gets knocked out. But that's the way I would think about it. So I want to be fading the S&P, and I want to be long the Russell and broadening out right now. And that will look very dumb, by the way, if payroll is very hot and interest rates go higher, but that's our call.
Do you hedge that, Dennis, or try to?
If I was going to hedge that, I would be hedging that in debt sustainability baskets. That's where we're so there's a lot of baskets out there that would do very poorly if 10-year yields move higher that have debt sustainability concerns. So the way to think about that is low coverage ratios with high earnings volatility. A basket like that, I think, is kind of an ideal hedge against a spike in interest rates.
All right, Dennis, always wonderful to talk to you. Dennis DeBuscher there. He's the president and chief market strategist at 22V Research, helping us count down to the closing bells. Just about 3 minutes to go here, Alex. Stocks pretty much green across the screen, with maybe the exception of the Dow Jones Industrial Average. But you had that board up a little bit earlier, and you saw the lopsidedness, right? A lot of money going into the Russell, not necessarily into the S&P and NASDAQ.
Nope, and that's the soft landing, right? You can still have higher yields, and you can still have stocks go well, because if the economy is actually doing well, and that's why you have the higher yields, therefore stocks are a good play.
Yeah, and even when you go through the S&P and you look what's leading, it's not the names that we would normally look to, the Apples and Microsofts of the world. It's Norwegian Cruise Lines, Constellation Energy, Carnival, AutoZone, Albemarle, and Palo Alto Networks, one of the few tech stocks at the top of the league.
I mean, that's like all across the board. Norwegian doing really well, even though there was a near Mauritius. Remember, people couldn't get off because they thought there was cholera. Did you hear about this?
No, I don't have Mauritius in my news feed. What happened?
One of the Norwegian cruise lines, they wouldn't let people disembark recently because everyone had this tummy bug, but they thought it was cholera.
Okay, I thought that was standard with cruise ships.
Tummy bugs? Yeah.
All right, we are moving closer to the closing bell. Full market coverage coming up right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. Here to help take us beyond the bell. It's a global simulcast with Scarlet Fu, Carol Massar, Tim Stenovic, as we bring together our audiences across all of our Bloomberg platforms, television, radio, originals, our partnership with YouTube, and I'm sure something else I forgot, Carol Massar, when I got off that ship back in Mauritius. Yeah.
Everybody's like watching. What can we tell you? We're kind of popular kind of people. Having said that, the market overall, I feel like a little bit.
Yourself.
No, I think we all are. All right. A little bit meh, I feel like, among the major equity averages, but we always like to talk about the small cap space. What we're up 4 days in a row. We're looking at about a 3% gain in that time. So it's interesting to say when we talk about broadening out or the outperformance among those small cap names.
Bitcoin, I got to go there because there's outperformance once again there. Up another $2,000 per Bitcoin, over $56,000 per Bitcoin. It trades all the time, but today, at its current level, it's the highest, going all the way back to December of 2021. And at the highest levels of the day, Scarlett, going all the way back to November of 2021.
And you see that reflected in how spot Bitcoin ETFs have been trading and certainly have been taking in inflows. I think almost all of them have been taking in inflows with the exception of Grayscale, whose pricing is much higher than the other Bitcoin ETFs.
Yeah, so risk on. However, we talked earlier about how some of the economic underlying data we got today really wasn't great. Consumer confidence really wasn't great. People are very worried about their jobs. They don't feel good about it.
Yeah, I'm glad you brought that up, and you saw durable goods as well. I know that goods story has been sort of soft for a while now, but you're not seeing a rebound there. You're not seeing a rebound in consumer confidence. The only silver lining in that consumer confidence report is that inflation expectations are still coming down. All right, we get the closing bells here in New York. A bit of a mixed day here in the markets with the Dow Jones Industrial Average been in the red for most of the session, and that's where it's going to end. Down roughly 100 points, or about 0.2%. The S&P, meanwhile, is going to finish higher by roughly 9 points, or about 0.2%. The NASDAQ composite is higher by about 59 points, or 0.4%. Let's talk about the Russell 2000. 27 points added to the index on the day, a 1.3% gain, and that's going to be the third straight day where we've seen outperformance by the Russell relative to the S&P.
Well, and as Alex said, some outperformance here, maybe a risk on trade to some extent, but despite some not so great economic news. Having said that, you take a look at the S&P, speaking to that risk on trade. Most names in the S&P 500, Scarlett, higher today, 314 to the upside, 187 losing ground.
Yeah, if you look at the sector performances, it may not just be picking up some risky assets, but also some perennial laggards. The utilities index up 1.9% on the day. That's the big gainer, even as it's one of the smaller sub-indexes in the S&P 500. Chris Verona of Strategic has pointed out that utilities is one of the only sectors that's trading below its long-term trading average. In the meantime, the sectors that are in the red, energy, healthcare, and consumer staples.
All right, guys, to the individual gainers we go. Macy's, that stock's definitely outperforming, coming off, though, its highs of the day when it was up about 7.5%, finishing the day with a 3.4% gain, nearly 3.4%. We know this story. Romaine doing some great reporting, talking to the CEO. The company's saying it plans to close almost a third of its namesake U.S. locations, as the company's looking to fight off a pair of activist investors who are looking to buy the company. So a lot going on that one. Investors seeming to like that news from Macy's today. Let's get to Viking Therapeutics. Man, this one soaring in today's session. Probably not a name that's on everybody's radar, but maybe it should be now. Stock up 121% today. It's an $85 stock, soaring after the drug developer said a mid-stage trial of its experimental therapy for patients with obesity met its main goal. So analysts really liking it. Leerink Partners calling it a clear win. So some views from the street. And one more, the cruise names outperforming in today's session. Norwegian, number one gainer in the S&P 500. That stock gaining, let me just pull it up about 20% in today's session. It forecasted adjusted first quarter EBITDA that surpassed the average analyst estimate, surprised investors, so it lifted the overall group. We saw Norwegian, we saw Carnival, we saw Royal Caribbean all trade higher throughout the day.
So they weren't affected by what went down in Mauritius?
I guess not.
Oh, okay.
Tummy bug, maybe cholera.
I don't know.
I heard you guys talking about this a little earlier today.
What happened to just old-fashioned food poisoning?
Ugh.
It was probably that, or but it was a vomit and diarrhea situation, I think, that then got the cholera
How do
scare.
I
That's not my first
transition?
choice when I think about vomit and diarrhea, but okay.
Well, Alex, you know what?
Oh, gosh.
I was thinking of you with my first
You
decliner.
guys went there. You guys went there.
I didn't go that far.
Okay.
There is a virus going around.
This one's for Alex, okay, of my decliners. Among the worst performers on the day. It's actually kind of tough to find decliners today, but one of the standouts was Chevron. Hess Corp actually also fell too, but Chevron slipped after ExxonMobil said it's considering a move that could break up the company's $53 billion merger, Chevron and Hess, that is, and increase its shares of Guyana's giant offshore oil reserves. Exxon did say late Monday that it's exploring its right of first refusal over the change of ownership in Hess's 30% stake in Guyana's massive Stabroek oil field. Alex, is this could this happen? Could this deal be off?
I mean, I think the lawyers are probably most definitely getting involved, but I was telling Romain earlier that you think of all the reasons why the deal wouldn't happen, this wouldn't have been on your radar.
Right.
This would have been a Venezuela thing, an antitrust thing, another bidder maybe coming in. This was not one of those things.
Okay, well, Chevron finishing the day down by 1.48%. Hey, JM Smucker, ticker SJM, the company fell after it reported worse than expected earnings per share forecast for the fourth quarter. Let's talk some numbers here. The company forecast a fourth quarter EPS decline in the mid-teens. That was worse than the Bloomberg consensus estimate, calling for a 9% year-over-year drop, falling today by 2%. And then I just wanted to talk about UnitedHealth really quickly. The Wall Street Journal story that came out just moments before the bell closed, causing shares of UnitedHealth to fall by 2.27%. It fell as much as 2.5% when that headline hit. The Wall Street Journal reported that the Justice Department is launching an antitrust investigation into the health insurer.
Yields, I got to say, a little bit higher, but nothing too exciting. The reason why I'm highlighting them, though, is we got a ton of supply over the last 24, 48 hours. A lot of supply over in Europe, record corporate bond issuance, and the takedown continues. Like, there is the demand there for all the supply that's coming online, even though yields creep higher, Romain.
Yeah, absolutely. And it gets to this issue that once we do get the latest batch of economic data, or at least the ones that really matter, which is really going to be that PC inflation report, whether that changes the dynamic that we've seen in the bond market, which, quite frankly, over the last few days has been stasis.
Yeah, absolutely. A whole bunch of earnings just crossed right now. Let's start with eBay, which has just come out. And of course, for fourth quarter net revenue, $2.6 billion. That does beat the average analyst estimate of $2.51 billion. Gross merchandise volume, which is what everyone's looking at when it comes to eBay for the fourth quarter. I'm just going to pull this up right now. Gross merchandise volume, $18.6 billion. Analysts were looking for $18.16 billion. Alex.
Yeah, and also we're looking for the take rate. I'm just going to try and find that for you. So how much they're making on each transaction. It was a strong promotional retail environment overall. So wonder what that wound up doing to that take rate. The CEO is saying that they made significant progress towards their vision to reinvent the future of e-commerce for enthusiasts, and their organic gross merchandise volume growth improved year on year, Tim.
All right, let's look at shares of Virgin Galactic. SPCE is the ticker. Shares down after the company did report, down about 2% in the after hours. This after the company reported revenue that missed estimates. Fourth quarter adjusted EBITDA loss came in at $83.8 million, Romain, versus estimates of $101.7 million. But I should say revenue coming in at $2.81 million, shy of estimates of $2.98 million for the fourth quarter.
Yeah, and I mean, it's kind of hard to understand sort of what the next step is for that company. Quite a few other earnings out there as well. Taking a look at Beyond Meat, it looks like a miss on some measures and a beat on others. Scarlet Bumble, the dating app, also crossing the wire as well.
Yeah, and Bumble cutting 350 jobs, so it's in cost-cutting mode like so many of the companies that are in the tech universe. It does see first quarter revenue of $262 million to $268 million. Analysts were looking for $277 million, so that is a miss there when it comes to the first quarter revenue. When it comes to first quarter adjusted EBITDA, $67 million to $70 million. Analysts were looking for $71 million. So again, that explains the job cuts as well there, as you see Bumble shares tumbling in the after-hours trade, down 9%.
All right, guys, let's go back to Beyond. Romain mentioned it. In this stock, we've seen it moving up a lot in the aftermarket. Let's get to, again, fourth quarter adjusted EBITDA loss of $125.1 million. The estimated loss was for $47.1 million. Fourth quarter net revenue, this is a beat, $73.7 million versus the estimate of $66.8. The stock is up 18% in the aftermarket. The outlook sees 2024 gross margin in the mid to high teens range and sees 2024 operating expenses $170 170 to 190 million. That's better than what the street was expecting of 221.7 million. Keep in mind that any upbeat news, and if you start to see some of that upward momentum, about 38% of the float has been shorted on this one. So I would it's safe to say some short covering happening.
Well, that's what I'm curious about here. I mean, how do you have a quarter like this where revenue's down 8% overall, and then when you look at the individual breakdown here, I mean, where's the growth?
Yeah.
What's the reset for this company?
I don't know, and that's what it's been figuring out. I mean, it's still down more than 90% in the past 3 years, so it's trying to figure out the way forward, right? We've all talked about this space, and it seems a bit tortured, to say the least, so we'll look for some more commentary maybe in the aftermarket. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow.
All right, stick with us. A slew of earnings crossing the wire, including Urban Outfitters. Those shares down 11%. Beyond Meat, one of the big gainers here in after-hours trading. A full breakdown of all the earnings that we just got coming up after the break, right here on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu with Romaine Bostick. For much of the day, the S&P 500 was in consolidation mode after, of course, closing at record highs last week, rounding off its closing records to 13 times so far in 2024. By the end of the trading session, the S&P 500 did manage to eke out a gain of about 0.2%. But for a second straight day, you started to see small caps really pick up some of the slack as they had been trailing their big cap brethren for most of the past 6 months. Now, you look at what's happening in the Treasury market, mostly lower after a third big Treasury auction this week, and of course, a slew of corporate bond sales yesterday and today. And of course, Bitcoin did surpass $57,000 earlier, currently just below that level at $56,804. As for movers, let's start with the decliners here. Chevron and Hess both down after Exxon came out and said it may try to break up their $53 billion merger by making a bid for Hess's stake in a Guyana oil project. You can see their Hess down by more than 3%. Janux Therapeutics was one of the big gainers here, a record jump to a record high, up 230% to just under $50 a share after the biotech firm gave updated efficacy data from its cancer programs. That was certainly encouraging, according to analysts, for its protocol. Now, when it comes to Norwegian Cruise Line, up 20% on the day. Its forecast for this quarter topped estimates despite disruptions from all the unrest in the Middle East. We saw Carnival and Royal Caribbean cruise lines also get a lift as well. Romaine?
All right, let's get back to some of the earnings out there. Urban Outfitters crossing the wire. It looks like a miss here on the bottom line number. Adjusted EPS in the most recent quarter, 50 cents a share. The street was looking for 74 cents a share. Now, the company did say that retail inventory in the most recent quarter also rose. Inventory up about 5% here, and that appears to be the bugaboo here. A big miss on the bottom line, relatively in line on the top line, but inventory levels rising, and you see the shares falling, down 11% here in after-hours trading. Meanwhile, going in the opposite direction is eBay. Those shares higher by about 5% here in after-hours trading. That company reporting the fourth quarter numbers that did come pretty much in line with estimates here, and a forecast for the first quarter also coming in line, about $2.5 to $2.54 billion in net revenue for the first quarter. That's what the street was looking for, 2.54 on average. Nicholas Jones joining us right now, equity research analyst over at Citizens JMP. And Nicholas, let's get right to it here. When you saw these numbers, what was your first reaction?
I think similar to yours, they were largely in line with what consensus was looking for. Outlook was in line. I think there's been a lot of concerns around the consumer heading into the end of the year and into 2024. So I think overall, inline results were pretty solid. What we did see, which I thought was a bright spot already, and we'll look to the call to get more, but their gross merchandise sales, or GMS per active buyer, was actually higher than what consensus would have implied. So that actually implies improving frequency among buyers. And the buyer numbers continue to trend in the right direction, where investors have really looked for those to trough and to start growing again. So I think that could be part of what's driving the price reaction here, some promising green shoots in the results and outlook.
Right. That's certainly a step in the right direction here, because for eBay, it's still very much in cost-cutting mode. We heard that with the job cuts that they announced recently. eBay has also said it's committed to returning around 125% of its cumulative free cash flow to investors. Today, it announced it is authorized an added $2 billion stock buyback. It has raised its dividend as well by 8% to 27 cents a share. Is that the best use of its cash, Nick?
I think right now, yes. They have a lot of exposure to a lot of different end markets. I think really what investors want to see is execution in their focus categories like parts and accessories and jewelry and sneakers and watches and things like that, where they've invested in authentication. They made acquisitions like TCG Players. So I think investors want to see optimizations, which they've been doing. They're cutting costs. Returning cash to shareholders is a great way to kind of create a floor on the price. And really, to get the stock moving from here, it's, I'll go back to what I said earlier, it's really about frequency, which will show up in GMS per active buyer.
So what do you want to hear from eBay when it comes to how it's implementing its cost savings in order to upgrade the stock to a buy?
I'm going to go back to what I've been saying. We're really looking for comments around frequency and active buyer growth. For this business, at the end of the day, if people aren't coming to the platform and purchasing things, and coming back and purchasing in more frequency, it's going to be hard to grow. So all of their investments and their cost savings have been really to focus on key categories where they think they have an advantage against broader e-commerce competitors like an Amazon or and Etsy, and drive those engaged audience buyers back to their platform to spend more money. So I think what we want to hear is we don't want them really to stop the dividends or the buybacks. That's a great way to return cash to shareholders. They generate a lot of cash. It's really about how do you get active buyers on the platform more engaged, and how do you get the engaged buyers to spend more? That's really what we want to hear to get more constructive on the stock.
And when we talk about the performance of the CEO, I mean, when he was brought in from Walmart, there was a lot of talk about how this could really sort of turn eBay into something more than I think what for a lot of us it is. It's basically, if you're looking for collectibles or auto parts or other things here. We haven't necessarily seen that materialize, despite the fact that they still have managed to sort of, generate a lot of cash. But there are a lot of questions, Nicholas, as to why this is A, still a standalone company, and B, what is the longer term growth story if it is going to stay a standalone company?
Yeah, I think it comes down to them having a vision of focused categories, right? Parts and accessories for autos is actually a massive category. Fitment matters quite a bit to folks who are buying these types of parts. Early internet days, e-commerce companies often try to kind of be all things to all people, and really companies like Amazon have really been the ones who can succeed at that. So I think having more focus on categories where they already know they have buyers leaning in is what they're going to need to do to kind of survive, and I shouldn't say survive, that's maybe a little inflammatory, but that's how they will, what they'll need to do to win in the current environment is to get more focused. Specialization matters more today than it used to.
All right. Great to catch up with you, Nick. Nicholas Jones there over at Citizens JMP. A closer look at eBay. Those shares moving slightly higher here in after hours trading. All right. There is also a lot of news out there about, new entrants to the public markets. Klarna is apparently moving forward with its plans for a U.S. listing. Bloomberg has learned that the Swedish buy now, pay later giant could list as soon as the third quarter. Bloomberg IPO reporter Bailey Lipschultz joining us right now for a little bit more on this. And this isn't Klarna's first flirtation with coming to the public markets. What's different now than a year or two ago?
Well, I mean, it seems like they're really kind of teasing out banks, seeing what that valuation could look like. Bloomberg reporting that could be a valuation in the $20 billion range, so markedly higher than their last funding round back in 2022, which was $6.7 billion. So it does seem like kicking the tires, gaining traction, much like Reddit, which we've been talking about for the last few weeks, who actually did flip public. It does seem like, at least according to our reporting, that this could be a time that Klarna just goes ahead and kind of rips the Band-Aid off.
Yeah, you mentioned that it raised financing last year, or 2022, at a $6.7 billion valuation, but that was a huge drop-off from its previous financing that valued it at $45.6 billion. So when you hear of a $20 billion valuation that the company is seeking, is that considered aggressive, or is it just kind of ho-hum?
We haven't had enough of a time to really tease that out. Looking at the private markets, so secondary trading platforms, which are obviously well known to be illiquid, I've been talking to a few sources. They say it's in the $6 to $7 billion range, so still kind of where that last funding round was. So when you look at potentially $20 billion, would be the biggest company to go public since ARM last year after Labor Day, if they do in fact press the button to go public in third quarter. That does line up with Labor Day, but that $20 billion valuation, we've seen a lot of resetting of expectations from the buy side and the sell side.
And a resetting of valuations. I mean, this was a company that was worth like $50 billion on paper at one point, right?
Yeah.
I mean, I know it's worth less than that now, but.
Yeah, and that's been kind of the thing is their best comp is Affirm. You look at your public comparisons, and if they're doing poorly, you see stocks like that down 85%.
Yeah.
Trades down.
I am curious about some of the other issues that I think kind of maybe potentially derailed the IPO prior. That was some of the infighting that we at least learned about publicly amongst their backers as well as some of the board members. Has that all been resolved?
That's what we've reported, is that they at least kind of for the most part removed or moved on from those issues. Again, it's impossible to really know what's going on behind the scenes and kind of who's pulling the strings, and that's been one of the things that's been dogging Klarna, as you mentioned. A lot of people wanted to go public in 2021 when valuations were sky high. Here we are in 2024. Equities, for the most part, are at record highs, but if your best comparison's Affirm, not really anywhere near those peaks.
Yeah, and what's the state of the consumer and consumer spending? Because that's going to have to play a factor into how you value this company. Billy Lipschultz, a Bloomberg IPO reporter, a closer look at Klarna, which could come to the U.S. market as soon as the third quarter.
But if it wants that high valuation, maybe it's got to have a good story on AI, how it's going to incorporate AI into the buy now, pay later business
weight
model.
Loss.
There
or
you
maybe
go.
both. I mean, that would be the holy grail. But it gets to this idea, too, that we're talking a lot more about new companies coming to the market. You remember there was like a several-month period where I don't think we had this conversation at all because nobody wanted to come to market. So I guess the fact that they're at least kicking the tires and dipping their toe into the water, whatever the euphemism, I guess that's a good sign.
Although for Klarna, it's been talking about this for a while now and hasn't pulled the trigger just yet. So this might just be another step towards that inevitable listing whenever it does come. All right, coming up on the close, the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. This is the close on Bloomberg. It's time now for the top three. Every day at this time, we take a deep dive into the people at the center of the day's top stories. And first up is Elizabeth Warren. We spoke with the Massachusetts senator today about the impending government shutdown. Here's what she said.
This is the craziest kind of negotiation you would ever see. And that is that, as far as I can tell, everybody wants to deal, keep the government open. We've all agreed on what the numbers are. It's a budget deal, right? And everyone's agreed on it. And the Republicans in the House are just saying no. And it's hard to sit down and negotiate with somebody when you say, because you want what? And then some crazy thing flies in that the majority of Republicans don't even want, much less that you'll get Democrats on.
I feel like when she said negotiate, we needed quote marks around there.
Yeah, I mean, I don't know.
For both sides.
Well, okay, whatever. The fools in Congress need to get it together. I thought some of her other interesting comments, too, and you can check out the full interview on Balance of Power coming up in about 35 minutes. She had made a lot of interesting comments about antitrust issues, making the case that she has in the past, breaking up Amazon, breaking up Google, basically breaking up anything that's, in her mind, a little bit too big for their britches. Someone else I've been keeping an eye on is Jeff Curry. If you remember last year, he stepped down from Goldman Sachs. He had been there for like 3 decades, and the big question was, well, where is he going to go? We now learn where he's going. He's going over to Carlyle Group. He's going to be the chief strategy officer of this Energy Pathways Group over at Carlyle here. Jeff Curry, of course, really made his mark. What was it, like kind of predicting kind of that boom in China at the turn of the last century. He was very prescient about a lot of the issues going on over there. Now going to take this over to Carlyle and talk a little bit more about the energy transition.
Yeah, he goes from making calls on commodity prices in specific markets to actually investing in the transition to green energy, which is something that Carlyle has been talking a lot about. All right, let's move on to the last of our top three, and it's actually a twofer. It's Josh Harris and David Blitzer. Bloomberg has learned that the pair is in advanced talks to sell their minority stake in the Pittsburgh Steelers. Of course, the NFL has to approve all transactions remain, and Harris and Blitzer have a stake of less than 5%, but Josh Harris recently bought the Washington Commanders for $6 billion, sorry, missed it by $1 billion. And under NFL rules.
What's $1 billion from friends? So.
There you go.
So, I don't understand the story. So, I know Harris, he had to sell.
Yes.
There's no point in
under NFL rules
holding a stake in the Steelers if you got basically a full stake in the Commanders. But what's Blitzer's deal? Was he also
they came in together
to sell?
on it. Yeah.
So he's also part of that Commanders.
No, Josh Harris went in on Commanders on his own.
Okay. Oh,
Yeah.
but if he wants to sell,
Yes.
Blitzer's kind of on the hook.
Yes,
Yes.
yes.
Okay, I got you.
That's my
Do we know
understanding.
what Blitzer's going to do next? Is he going to go to Goldman for commodity research?
Or maybe Carlisle for Energy Pathways. How about that?
Or maybe he'll just reinvest it in another sports franchise, I assume.
I think he's been pretty active in the sports franchises, so we'll keep looking there.
Yeah. How is this Josh Harris and the Commanders? I mean, how's that working out? I mean, I know it's only been...
It's early days.
Yeah.
It's early days, so
So-
we'll see. I mean, they didn't have a great season last season,
Yeah.
so.
Yeah, I lived in Washington, D.C. for several years under the Snyder administration. And
So this is an improvement.
Let's just say he wasn't very well
Right.
loved.
So this is an improvement,
Yeah,
right?
So we'll see by the fans or the players. All right. When we come back, Scarlett, we're going to take a look back at this day in 2007 and the bursting of the China stock bubble. I'm going to leave you with the question before we go to break. What amount of Chinese shares were owned by foreign investors as of last year? You can give me the answer in yuan or in dollars.
I mean, it's a number, right? It's a dollar amount.
It's a number. Yes.
It's not a percentage.
No, it's not a percentage.
It's gone way
It is a
down
dollar
since
amount.
2008. I can tell you
Well,
that.
You're sniffing on the right track here.
All right.
We're going to have the answer when we come back after the break. This is The Close on Bloomberg. All right, equity markets in China this week resumed their advance to erase all losses for the year amid strong offshore buying. And that's a perfect opportunity to look at this date in history and the bursting of the China stock bubble back in 2007. It was a 9% plunge in the Shanghai Composite on this day 17 years ago, and what at the time was the largest drop in 10 years, and for what now is still the biggest drop today. That sell-off may have been more deliberate, though, than happenstance, with a regulatory crackdown articulated 3 weeks prior by the vice chairman of the nation's People Congress, who wrote in a commentary that the government must deal with market bubbles before they get out of hand. And maybe he had a point. The Shanghai Composite had more than doubled in 2006 and started off the first 8 weeks of 2007 with a 14% run. You had daily market swings of 3% or more. That had become the norm, and price-to-earnings ratios had swelled to more than twice some of its other Asian market peers. It was a wake-up call for China as well as for U.S. investors who had been betting on an economy that had grown from unmeasurable backwater to the fourth largest in the world. 10% economic growth, $1 trillion in reserves, and 1.3 billion people becoming richer every day. But bursting that bubble, it did have an existential impact on investor psyche, a psyche later scarred further by years of harrowing volatility and frequent massive drawdowns in the equity market. And that brings us to our question of the day. The amount of Chinese shares owned by foreign investors dropped 13% last year and more than 30% since a peak at the end of 2021 to just, get this, 2.8 trillion yuan, or about 390 billion US dollars. In fact, net purchases last year were the lowest since Bloomberg started tracking the data in 2017, and a separate analysis of 13 F filings for about 270 large U.S. pension funds last year found that just 14 of them had investments in U.S.-listed Chinese stocks. China's state-backed funds have sought to reverse that trend, pouring the equivalent of about $57 billion into on-share shares this year alone, according to UBS Group.
We like the China domestic market more than the offshore markets, because in domestic market, obviously, there is some policy support, but also national team, evidence of national team buying.
Beijing is also drafting a law to, promote better protections for property rights, as well as the interests of entrepreneurs. It is a prudent move, but will it be enough? Enough to convince foreign investors that it's safe to return? It's not an academic question either. With all the hype around China's growth story and all the hand-wringing over the latest rally, the Shanghai Composite still remains 50% below its all-time peak from 2007.
And that is why you often see inflows into EM ETFs ex-China, because China has lost its status as a market darling since the heyday of 2008, 2009. All right, let's return now to the earnings bonanza we got at the top of the hour. Vizio, the smart TV maker, posted fourth quarter net revenue of $502.6 million, pretty much meeting analyst estimates. But the big story when it comes to Vizio is really its deal with Walmart. So here now in studio with us today is Dan Day. He is Senior senior equity research analyst at B. Riley Securities. Dan covers media and advertising. He currently has a neutral rating on shares of Vizio. The earnings don't matter as much as what the future of Vizio looks like. Can you just explain to us how exactly Walmart is going to utilize Vizio in the near term versus what it's going to look like maybe in 5-10 years from now?
Yeah, so a lot of people probably know Vizio as a TV manufacturer. I think that's what most comes to mind. So one thing Vizio did about 3 or 4 years ago is they really started to invest in the software side of the TV. So I think like phones we have today have a hardware component. You might have a Samsung phone with the Android operating system. TVs, as people have switched from cable and satellite to streaming, also have that operating system component to them. So what Vizio did was build out that operating system so they don't have to use something like a Roku or a Fire TV. That's primarily what Walmart wants out of this deal is that operating system, because with that they get a lot of valuable advertising inventory, and every retailer out there is trying to build an advertising business that's a lot higher margin and complements that sort of low margin retail business that they all have.
So how's it going to look different or similar to what Amazon has? Because a lot of people say Walmart is trying to build out its own Amazon Prime, but we're talking about different audiences.
Yeah, so you know, they won't have the scale that like a Fire TV has somewhere between 40 and 50 million active accounts, right? And so they have their own TVs that they sell through Amazon, which is, you know, the biggest channel that they move, and then they have licensing deals with others. Vizio, as of you know, the print this afternoon, is about 18.5 million active accounts. And the only way Vizio gets an active account is moving a Vizio TV. They don't have licensing deals with other hardware partners. So what Walmart wants to do is take that, and Walmart also sells the On brand. That's their house consumer electronics brand. You know, theoretically, my sense of what they would do is they have a deal with Roku with the On brand. They would move SmartCast, which is Vizio's operating system, onto the On TVs, and they would sell that SmartCast through both the On and Vizio TVs. So you would go from 18.5 million accounts to really closing the gap with what a Fire TV or a Roku might have in terms of scale.
So when we talk about sort of what this ends up adding to the bottom line, I mean, we've been talking about a company in Walmart that has seen its gross margin shrink, even by, you know, retail, low-end retail standards. It's gotten pretty small. How much will this potentially improve those margins once they've fully integrated it?
So the dollars are small because Walmart's talking about hundreds of billions of sales, right? You know, Vizio, as of the most recent, less than $2 billion.
Yeah.
Right. So it's not going to move the numbers to an extent, you know, immediately.
Yeah.
What it will do is help Walmart build out a brand advertising business like Amazon has and let them better compete with them. You know, people wonder what Amazon's doing with things like putting ads in Prime TV and Thursday Night Football. What Vizio will bring to the table for Walmart is the ability to sell those brand advertising spots.
Okay, because I was going to say that makes sense for Amazon.
Exactly.
I do sort of wonder how it makes sense for Walmart.
So what Walmart wants to do, and you know, you think about they're competing for ad dollars with Amazon. What Amazon can do is take advertiser X and sell them the typical performance marketing. You're searching for backpacks on Amazon, you see, you know, the paid sponsored, so that's performance marketing, right? With Amazon Prime and, you know, things like Thursday Night Football, they can also sell them those 30-second TV spots.
Okay.
What Walmart wants out of, you know, buying Vizio and having this ad inventory to sell is to also have that connected TV brand spots to sell, right? So they sell that performance on the Walmart.com website. You know, paid search, you could call it, and they don't really have any of, you know, the equivalent of what Prime has. So
okay, but this ends up still, Vizio ends up being a Walmart property, right?
Yes.
Okay.
Yeah.
So I have a question here about Roku, because Roku is obviously a competitor to Vizio, and we saw its stock tumble on news of this deal. What happens next to Roku? Is it forced to go find an acquirer, like a Netflix maybe?
Yeah, I mean, people have speculated about that. I think what Roku, I think there are a lot of puts and takes here for thinking about Roku, right? The stock stumbled because, as I mentioned before, Walmart's On brand uses Roku as their operating system. So investors are speculating that Vizio's SmartCast would kind of replace that, and that'll make it tough for Roku to grow those accounts. Now, there's kind of second order thinking there. If Walmart owns Vizio, does suddenly Target and Costco feature Vizio TVs less prominently? And all of a sudden, those TCL Roku TVs are kind of, you know, moving more out of others. So, you know, I think that there are a lot of ways this can play out. I'm not as sure it's as negative for Roku as a lot of people think.
All right, Dan Day over at B. Riley Securities. A closer look here at the Walmart Vizio deal, and we're going to continue the conversation, broaden out just a little bit with Chris Horvers. He's the head of retailing on broad lines and hard lines over at JP Morgan. He's got a neutral rating on Walmart. Chris, I mean, is this going to be money well spent overall on Walmart's part?
Well, I think if you look back at Walmart's history, it's really under Doug McMillon, who became CEO in 2015, they've really showed they're willing to throw a lot of stuff against the wall. You'll recall the Jet acquisition just now closed. Yeah. They acquired Flipkart. In India, they acquired Bonobos. They sold that. They acquired Moose Jaw Sporting Goods online retailer. They sold that as well. So I think they're willing to try, and they have the balance sheet to do so. Mm-hmm. You know, it's going to be slightly, dilutive to earnings, but the promise is the alternative profit pool. So to your question earlier, Walmart has roughly a low 20% gross margin.
Right.
These advertising revenues could potentially come in at 50 to 70% gross margin.
Yeah.
So small dollars is big rate. And ultimately, that's the promise of taking the earnings growth algorithm from what had historically been maybe mid-single digit,
right,
and getting it to high single digit to low double digit.
And I understand that Walmart kind of has its own ecosystem, a very profitable ecosystem, if you will, Chris, but there's been some concern here, the idea that once Vizio's under that umbrella here, there's not a lot of incentive for some of the other retailers to carry these TVs as well, that this could end up being just a Walmart product. Does that matter?
I don't think it necessarily. I mean, there could be some loss in terms of the sales. They're not Vizio, as I think your prior guest would tell you, they really just manufacture the TV and sell it at zero profit. So all the profitability of Vizio is in the advertising business, and it's not sufficient to generate any profit at this point. So, I think if you think about the market share in the United States, Best Buy is the largest TV retailer, call it 30% share. Mm-hmm. Amazon's not far behind that. And then Walmart would be basically third. I do think you're not going to see Vizio like you would historically see at a Best Buy. Best Buy has its own brand called Insignia, where they also have the software. And so you'll see some lost TV sales I would expect for Vizio, but they're essentially losing money on that in the first place.
Well said. So, Chris, what kind of investment or spending will Walmart need to do in order to build out its Vizio, its connected TV business?
Walmart has multiple alternative profit pools. The largest and most profitable piece of it is the advertising side. A lot of that is really, particularly in the grocery side, where they're charging Pepsi or Procter for placement on its website, tracking consumers around the web, being able to match an ad that they serve up on their website to a sale in the store. That is profitable, and this will make that business more profitable. So it's more about the advertising business growing and funding other alternative profit pools, which have yet to be material or even losing. So, for example, if you think about their third-party merchandise offering on their website, if you think about their health initiative, mm-hmm, it's really about the entire profit pools working in tandem.
Got it. Everything kind of running on the same platform. Chris, really appreciate your joining us. Chris Horvers over at JP Morgan, giving us a little more insight into how Walmart is going to integrate Vizio into its overall strategy. Let's take a look at how markets closed on the day. We actually finished higher after being lower for most of trading today and, in fact, this week. You see the S&P 500 staying above that 5,070 level, up 0.2%. Treasuries mostly lower after the market absorbed three big Treasury auctions this week. Demand has been okay, not great for some of the auctions. Dollar unchanged at the moment, and New York crude, WTI moving up 1.3% to finish at 78.56. This is the close on Bloomberg. Consumers, we know, are sticking to their budgets these days, and discount retailer sales may be thankful for it. We'll see when TJX releases results tomorrow morning. Joining us now for a preview is Barclays senior retail analyst Adrian Yee. And Adrian, of course, TJX is the parent company of TJ Maxx and Marshalls, along with Home Goods. We know that the fourth quarter earnings reports that have come in so far have indicated that consumers are willing to spend, and they were willing to spend during the holidays. But the question is how much that spending may have slowed or is slowing in the new year. What do you expect to hear from TJX?
So TJX for the fourth quarter just was spot on. We call this their peaking moment, meaning that you are sort of at maximum holiday pressure on the consumer. And while the consumer was still healthy, they were absolutely looking for value and a bargain. At the same time, you had probably the best branded inventory that's been in those stores probably for the greater part of the last decade, frankly. So it was a combination of two different things, one on the top line, requiring kind of people to look for value, and then this great product throughout all of their banners.
So I'm curious about the best branded inventory, because we've heard from retailers that managing their inventory has been top of the list for all of them. And the idea is that they don't have a lot of excess inventory to then push down to the discount retailers. How is TJX able to maximize and optimize its inventory when you have that kind of environment where the retailers themselves are doing a good job managing it?
Yes. So there were two parts of the kind of source of these inventory, so to speak. At first, it was kind of the first half of the year. They were getting all their inventory from what we call retail closeouts, the back half of 22 and the early part of 2023. What then happened was the retailers wanted to be clean. And so they stopped buying from the branded manufacturers, right? So, be it Nike or whomever. And so the pig and the python kind of moved backwards, right, into the python, so to speak. And so they started getting a ton of, branded inventory from the manufacturers directly.
I see.
At the end of this cycle, at the end of this holiday, you're right, things will get normal. They will start to normalize.
So the expectations, though, Adrian, I mean, we're talking about 4.1% comp sales growth, at least based on the Bloomberg estimates here. When we talk about the idea of what that threshold is between, I guess, what's going to make investors happy and what's going to make them sad here, is 4% more or less the break even?
I would say that the expectations for TJX are a little bit higher than that. 4% being sort of their, to use your word, right? It's actually their break even comp. So anything above 4% flows through. So if they do a 5%, 6%, all of that just magically flows through and becomes kind of, marginal profitability. So I think the over-under, quite frankly, is to see a solid 5% comp. And I think you're going to see that, higher at the Marmaxx division. But frankly, I mean, the home goods piece of it really came through last quarter. So if they can get both of those pieces of the business doing mid to high single-digit comp, I think you'll have a stock that's going to look green.
As the lean into the home products, not only at Home Goods itself, but even the household products that they carry in the TJ Maxx stores themselves, has that become much more of a driver of growth than apparel would be?
So exactly. So from 2019, where you would walk into a Marshalls or a TJX, and it would be primarily apparel and footwear, you walk into that store now, it has beauty, fine jewelry, luggage. There's an entire section of consumables, gourmet products, cookware. And so the expansiveness of all these categories, right, all these TAM, right, addressable market opportunities over the past 5 years has, frankly, kind of, multiplied. So I think they're in a much, much better position. And then even as you say, on the home goods side of things, they don't sell furniture, right? So I think people have a little bit of a, negative side on kind of the home sector and furniture. But these are small items and decorative items that, more disposable income in nature.
Oh, yeah, I know. I mean, we were washing comforters this weekend, and I asked my wife why we had 12 comforters, even though we only have, 3 beds in the house. But
TJX?
That's a whole nother conversation, Adrian. But yes, she is a TJ Maxx fan there. So thankfully, she's not spending a lot on them. Adrian Yee giving us a nice preview of TJX. Those earnings expected to cross the wire tomorrow morning. Team Surveillance will have full coverage of that. Stick with us here, though, on the close. We are going to set you up for some of the other big market-moving events for the next 24 hours. This is Bloomberg. All right, more earnings coming down the pike tomorrow, including from Paramount. Geetha Raghunathan joining us right now over at Bloomberg Intelligence for a preview of what to expect. And Geetha, are we going to be talking about the actual earnings and numbers here, or are we going to be talking more about, well, the suitors for this company?
Yeah, that's a really good question, Romain. So with Paramount, yeah, it's always been about all of the M&A noise. And just today we had some headlines crossing. It looks like, Warner Brothers Discovery is kind of formally dropping out of, any merger talks. So this is bad news for Paramount because the list of potential suitors is definitely shrinking. We also heard a few days ago that Berkshire actually cut its stake in Paramount by about a third. So definitely options are running out.
Options are running out, and this is something that, of course, the Redstone family, Sherry Redstone, will really have to work on here. But another issue for Paramount is that S&P recently put the company on credit watch for a possible downgrade, and it said it will make an actual decision on the rating after these fourth quarter results. What does Paramount need to show in order to avoid a downgrade?
Yeah, Paramount really needs to show some kind of, streaming profitability improvement. So they did report about $1.8 billion in streaming losses in 2022. They are supposedly going to pare that down to 1.7 billion, but I don't think that's going to be enough. Ultimately, the problem for all of these linear TV companies, and especially Paramount, which has a really heavy debt load, as well as heavy linear TV exposure, right? Over 50% of its revenue comes from linear TV. 90% of EBITDA comes from linear TV. So that's really, really high exposure. They have to show that with that streaming pivot, they're able to offset the losses in their linear TV business with, some kind of revenue and profitability in streaming. Unfortunately, it's going to take a long time for them to get to any level of even break even in the streaming business. And that's really what the investors are going to look for. Unfortunately, I think they're still going to report about 1.7 billion in 2023 streaming losses.
Yeah.
It's going to be bad even for 2024.
All right. I think a lot of folks are going to be keeping an eye on that when it moves tomorrow morning. Geetha, our thanks to you. We'll catch up with Geetha Raghunathan tomorrow over at Bloomberg Intelligence. In addition to those earnings out of Paramount, some other potential market moving events, including a rate decision over in New Zealand.
Yeah, the Reserve Bank of New Zealand comes out with its decision in just a couple of hours, and economists are expecting it to keep its main rate unchanged at 5.5%.
Meanwhile, back here in the U.S., we are going to get a revision on those quarterly GDP numbers, and we're going to get quite a bit of Fed speak as well tomorrow.
Yeah, the second quarter GDP, or the second read, I should say, a fourth quarter GDP is expected to stay unchanged at 3.3%. That was the initial read. And of course, it's all in the build-up to the big PCE number on Thursday.
With a lot of Fed speak tomorrow, as well as the G20 finance ministers, which are meeting along with the central bank chiefs over there in Sao Paulo, Brazil. We got a little bit of a taste of that earlier today with that draft communique that Bloomberg managed to obtain.
Yeah, and of course, we look ahead to earnings because earnings season is not over. In the morning, we've got RBC, we've got TJX, which we just talked about, and WW, the company formerly known as Weight Watchers.
Weight Watchers also going to get some big technology companies, particularly in the after hours. A big one out of Salesforce. And I guess you could throw HP in there as well. Not quite as big as Salesforce, but certainly one to keep an eye on. Really appreciate you joining us today here on Bloomberg Markets to Close. We'll be back tomorrow with full coverage. Meanwhile, stick around. Balance of Power is coming up next after this program. A closer look at the world of politics and a deeper dive into that interview that we teased a little bit earlier with Elizabeth Warren, Senator Elizabeth Warren. This is Bloomberg.